In 2021, ProPublica revealed that the 25 wealthiest Americans paid an average effective tax rate of 3.4%. Some paid nothing at all. This is not tax evasion. It is the tax code working exactly as designed. Just not for you. Warren Buffett once told Congress that he paid a lower effective tax rate than his secretary. He wasn't complaining. He was explaining how the system works. In 2021, a leaked IRS database obtained by ProPublica revealed the actual taxes paid by America's 25 wealthiest individuals over a 5-year period. Their combined wealth grew by $401 billion. They paid $13.6 billion in taxes. That is an effective rate of 3.4%. The average American pays over 14%. This is not cheating. This is the tax code doing exactly what it was designed to do, just not for the people who paid for it to be written. The foundational strategy of ultra-wealthy tax avoidance is known as buy, borrow, die. It sounds almost too simple to be real. Here's how it works. You buy appreciating assets, stocks, real estate, private companies. As those assets grow in value, you owe no taxes. Capital gains are only taxed when you sell, so you don't sell. Instead, you borrow against your assets. A bank will happily lend you £100 million if you pledge £200 million of stock as collateral. The loan is not income. It is not taxable. You use that borrowed money to live, to buy more assets, to fund your lifestyle, to do whatever you want. You continue accumulating appreciating assets. You never sell. You never trigger a taxable event. When you die, your heirs inherit the assets at their current value. A step up in basis means the accumulated gains are wiped out. The tax that was never paid is never paid. For those who want additional protection, offshore structures provide another layer. The Cayman Islands, British Virgin Islands, Luxembourg, and Ireland have built entire economies around providing legal structures that reduce or eliminate tax obligations for wealthy individuals and corporations. A typical structure might involve a holding company in Luxembourg that owns intellectual property, licensing it to operating companies in high-tax countries for fees that reduce those companies' taxable income. The profits accumulate in Luxembourg, where the effective corporate tax rate can be as low as 0.01%. Apple used a version of this structure, the double Irish, to shelter hundreds of billions of dollars from US and European taxes. In 2016, the EU ruled the arrangement constituted illegal state aid and demanded Ireland collect €13 billion in back taxes. Ireland appealed the ruling to protect its tax regime. A country was fighting to keep its arrangement to help a company pay less tax than its own citizens. Charitable foundations sound philanthropic. Many are. But they also serve as extraordinarily effective wealth preservation vehicles for their founders. Here is how the mechanism works at its most aggressive. A billionaire donates appreciated stock to their private foundation. They receive an immediate tax deduction for the full market value of the stock, up to 30% of their income per year, with a 5-year carry-forward. The foundation pays no capital gains tax when it sells the stock. The foundation is legally required to distribute only 5% of its assets annually to charitable causes. The remaining 95% can be invested, growing tax-free indefinitely. The foundation can employ the founder's family members, pay for private jet travel to charitable conferences, and fund research aligned with the founder's interests. When the founder dies, the assets in the foundation are not subject to estate tax. None of this happened by accident. The tax code in every major economy is extraordinarily complex. The US tax code runs to 6,871 pages, because complexity creates opportunities. And those opportunities were deliberately created by lobbying. Between 2010 and 2020, the financial services industry spent over $3 billion lobbying the US Congress. The private equity industry successfully lobbied for the carried interest loophole, which allows fund managers to pay capital gains tax rates, typically 20%, on their income, rather than income tax rates of up to 37%. This single provision saves the private equity and hedge fund industry approximately $18 billion per year in taxes. The argument for it is that it incentivizes risk-taking. The argument against it is that a teacher, a nurse, and a hedge fund billionaire should pay income tax at the same rate on their income. In 2021, 136 countries agreed to a global minimum corporate tax rate of 15%, an attempt to end the race to the bottom in corporate taxation. It was heralded as a historic breakthrough. In practice, the implementation has been riddled with carve-outs, delays, and national exceptions that have blunted its impact significantly. The fundamental challenge is structural. In a world of capital mobility, wealth can move faster than regulation. A company or individual that faces a higher tax burden in one jurisdiction can simply relocate to another. Countries that attempt to tax wealth aggressively risk capital flight. This creates a prisoner's dilemma, where every country has an incentive to cut taxes to attract capital, regardless of the collective cost. The wealth gap between the ultra-rich and everyone else has widened dramatically in every developed economy over the past 4 decades. The tax system is one of the primary mechanisms through which this gap is maintained and expanded. Understanding how it works doesn't require you to be angry about it, though many people reasonably are. It requires you to understand the rules of the game you are playing. The very first step to building wealth is understanding how it accumulates and how it is protected at the top. Because the second insight, that many of these strategies are available to anyone who understands them, is the one the wealthy would rather you not know.